Netflix reported better than expected third quarter earnings with its ad tier membership growing 35%. The company said more than half of new signups in ad tier regions came from the ad-supported plan, though it doesn't expect advertising to be a key growth driver until 2026. Join us now, Barton Crockett, Rosenblatt Securities senior analyst. It was highly anticipated, and we're wondering, Barton, about a lot of things, and the new, not really transforming the business model, but it's at least changing a little. And supposedly subscriber growth wasn't going to be as important, but 5 million was a whole million better than people thought. Even though it's slowing, that was better. And then the ad-supported stuff was going to be closely watched. Was there something that really surprised you in terms of better than expected for the company? All right, I don't know.
Hey,
did we check
Barton,
the audio on
Barton,
that?
hold up just a second. We're going to try and get the audio fixed.
We can get the same guy that did that Obama-Biden conversation. They got a lip reader to do that. It was pretty funny. At the end, it was pretty funny.
It was. That's just, yes.
Are you back, Barton? And can you start from scratch? So, what was there anything that you went, wow, that's much better than I thought?
I'd say no. There was nothing much better than I thought. I mean, we have a neutral rating on Netflix, and I think our caution, it's a great company, but our caution is that they've had a huge lift from some of these efforts like the paid sharing initiative, which they're lapping, which are fading. There's a lot of hopes baked into advertising, but that's a slow build. So it's a company that's decelerating. And what we saw was guidance that was consistent with our concern. They grew 15% in the quarter and the year, but they see 11 to 13% growth next year. They're adding like 600 basis points of margin in 2024, but next year they see only adding about 100 basis points, so a little bit of a pull forward this year. So, for a company that is, we think, on a decelerating kind of trajectory that trades at this type of multiple, it doesn't scream to us that this is something that you need to get a hold of and get long at this point.
It was screaming at 200. I know that, at $200 a share. It was screaming to get long, but you're right. So give me how you calculate what the multiple is on let's say, next year's results. Where are we right now?
So we're trading at somewhere around 28, 30 times kind of next year. The earnings growth rate, 24 to 26, is going to be in the mid to high 20s. We'll see where it comes out when they report. But so the PEG ratio is, a little bit stretched. They have growth. I'm not arguing that the stock needs to reset, but to argue that you're going to set it at a higher multiple when growth is decelerating, when they're losing the paid sharing lift, when the ad story is really going to take a few years to become material. And even there, it's not going to be, it's going to be years before it's 10% of revenues. It's probably low single digit now. It's a transitioning story in a market where there's a lot of, saturation. A lot of people have video entertainment, and a lot of the growth is really in the free stuff that Netflix doesn't offer. So, good company, brilliant, hats off to them. But, after this great run, I don't know that you have to really lean into it today.
Hence your neutral rating. So is it in now the same boat as all the ad-supported offerings? Because we thought of Netflix was like a different animal. It was like almost a unicorn, and all the other streamers were, sort of playing catch up. Now, is Netflix human after all? Is that they're going to finally be held hostage of whether they can get ads going? And it's going to take, as you say, it's a slow build. When does that become something they'd even break out and be something where you go, wow, that's really great? That could be 3 or 4 years, couldn't it?
Yeah, it could be a few years before it's broken out. I mean, I think they're talking to, critical mass of audience in 2025 in their ad markets. And I think they do see a long tail of growth. So, perhaps it's 2% of sales now going to 3% next year. In a few years, maybe it'll be 10%. For your ad growth, you have a little bit less leverage on subscription pricing because you're not really raising prices on the ad tier. You're raising it on the non-ad tier, and it kind of mitigates your pricing leverage. So, the ad stuff has to take over, and it's transitional. And that just kind of, is a bit of a capper on your growth rate. So you got to be careful about what you pay for this stock.
So what's the most important thing content-wise for Netflix? And it's hard to get hits. Sports is easy, and they're trying to do that, obviously.
Yeah. Look, I mean, I think they are going to have a stronger content cycle. They've been held back a little bit by some of the production. Snafus from the strike, that seems to be fully resolved, and I think you'll see a better cadence of content for them in the fourth quarter of this year and into next year. They're bringing back Squid Game in the fourth quarter, and that's really the biggest show ever for them. And the hours streamed of Squid Game are like over twice Bridgerton. So that's a big title. We'll see if it still clicks like it did in 2021. The Stranger Things, is also coming back. Wednesday is also coming back next year. And then they've got the NFL, which, we know what the audiences are on TV in this country, huge number one. So they've got some new things coming. It is interesting to me that with all this content, they're still guiding for a deceleration in revenue growth. It's, I wonder about that. I wonder about some of the flattening of some of the usage metrics that they've reported, where you've seen declining share of Netflix in the U.S. Even as they've been growing subscribers, so some signs of maturity. Great company, but trees don't grow to the sun. There's a place where you have to level off and be more kind of normal.